Chicago. We're going to talk about the plunging bond yields that we've seen this week. But first, this data. Joe Lavorgna, the chief economist of the Americas at Natixis, CNBC contributor. Also, Jim Luorio from TJM Institutional Services, managing director, also CNBC contributor. Gentlemen, great to have you both. Joe, first, your reaction to the data we just saw. If you're Jay Powell, how do you read that?
Jay Powell, I'm still cutting rates because I'm looking at the yield curve, and I made a big mistake by tightening in December. CPI is lagging, and they're going to keep cutting because they're worried about dollar strength.
We heard a guest earlier today say 100 basis points need to be shaved off rates.
Yeah, I think that's right. I think that's right. And then maybe more next year and certainly more in 2021 after the election.
Powell has said his goal is to keep the expansion going, to extend the expansion as long as possible. But if you get to zero by doing that, what tools do you have left once you actually get to a recession, once the expansion?
The advantage of getting to zero is then we'll be done. Monetary policy will effectively reach its limit. I mean, it's already almost there, but effectively they won't be able to do anymore. Then we'll turn over to the fiscal side, and then we'll spend whatever we want to spend money on. But at least the Fed won't be part of the equation. In the short term, Kayla, you need a weaker currency, especially against the EM markets. And the Fed won't have a choice but to follow rates lower.
Yeah. Jim, let's bring you into this conversation. We're watching the spread on the 10-year and 2-year drop. It's down 23% let's see what that time frame on that. I'm looking at a 1-week chart, but it's unclear what the percentage pertains to. We're watching it go down, though, Jim. And interestingly, we're watching the yield on the 10-year go up slightly. It firmed a little bit to about 1.66. Do you think that's the right reaction in the bond market?
I think it's fine reaction when $15 trillion are trading at negative yields, and you guys talked extensively about that before. And I would just add that if ultra low and negative yields worked, then Europe would be fine right now, and clearly they're not. But as far as the predictive power of 2s to 10s goes and more, I think it's diluted some. I'm not going to say it doesn't matter at all, but I'm going to say there's huge distortion in the long end of the yield curve with that $15 trillion of negative yield. So if it goes negative, if we have an inverted curve, first of all, the average recession doesn't start between 14 to 18 months later. So I think it's the wrong time to panic now if that happens. And secondly, I'll say it has much less impact to me viewed in the lens of the distortions.
Well, one of the reasons why people are so worried about the spread is because it is the narrowest spread since, I believe, June 2007. And you remember what happened in June 2007. But the psychological fear is everyone remembers what happened next. And there's this view that, OK, we're getting into the same scenario as we were then. But obviously, the economy is so different from June 2007 for a whole host of reasons. But does that date spook people?
Of course it spooks people. Anyone who's our age and has been through the tech bubble boom and then the real estate boom. But when the recession happens and we start to pull back the wallpaper, we start to see what the foundation looks like. So you have to ask yourself right now, do we have those kind of excesses build up? The answer to that to me is absolutely not so far. Anecdotally, you don't see people, borrowing everything they can, mom and pops buying real estate or buying Bitcoin or buying whatever. Right now, it's just, to me, it seems like a garden variety recession. I think we are inflating bubbles, but I think they're diffused across a wide variety of assets, and I don't think they're at any point now where it's going to blow up in our face. I don't think this is a great thing either. I think, we used to have recessions every 2 to 4 years. In the last 30 years, they're only every 9 to 11 years, but then when they come, they're massive because we keep pushing people into risk assets like we did twice so far.
Right. I mean, Joe, retail sales have been positive. The consumer confidence has been good. Just this morning, we got a good read on NFIB, small business sentiment. So do you see indicators of a recession, and if so, where?
I agree with Jim. Now's not the time to panic, but the curve is definitely telling you that growth is weakening. I mean, yes, yields overseas are low, and they're low largely because of ECB actions. But if there was inflation, people would be selling bunds and gilts and everything else. So the global economy is clearly softening. So the message from the curve is that yields need to go lower. And it's not that negative rates here or low rates in the U.S. will help. It's just we're in a globalized system. And what's happening overseas is pulling U.S. yields down, and they're going to stay lower. And housing will probably boom eventually.
But, Joe, don't you think there's some distortion from, the big 3 central banks being involved in this market for the last 10 years? Do you think, of course, so it doesn't have the same predictive power that it did in the past?
Well, I mean, look, if you look at break-even inflation rates in Europe and here, they're plunging. So I do think there's some predictive power. I mean, we were coming into this year, we were thinking, not us, but people were thinking that rates were going to go higher because global growth was going to be stronger, and it wasn't. So the curve, to me, is still very valuable. Are there distortions? Absolutely. But I just think that historically it's been pretty good. And if there was inflation risk in the system, you wouldn't see 10-year notes at 165.
Yeah.
You just wouldn't. They'd be 2 something, 2 1/4, 250.
Amen.
Right.